Hello, everybody, and welcome to our show today. Today, we're going to be diving in. We're going to be talking about how you can actually get money for a business. Now, we're going to probably go about 30, 40 minutes and go through, a lot of different ways that you can get funding. Maybe some of you have heard us talk about before and some that we've never talked about before. So for those that don't know me, my name is Ty Crandall. I'm actually the CEO at Credit Suite. And at Credit Suite, this is what we do. We actually do three things. We help you become more fundable, meet the criteria that lenders and credit issuers have, so you know you can get approved before you apply. We also help you with all aspects of building business credit and all aspects of obtaining capital through credit lines and business loans. So if we can ever help you along the way, feel free to give us a ring, 877-600-2487, info@creditsuite.com. And then we have a quick link where you can just go and see all the money you can qualify for at creditsuite.com/get funding. So make sure that you check out that link as well. So that being said, let's dive in and talk a little bit more about funding, about exactly how to get funding and the different types of options that are available for you. So every company obviously needs money. Okay, as a matter of fact, when we look at the two biggest reasons for business failures, we all know, we've heard before the rumors that many businesses fail, and it's very true. And statistically, the two biggest reasons for business failures are mistakes made by the owner or manager, and lack of access to capital. Now, the good news for me is that both of those revolve around the same topic of capital. As entrepreneurs, we don't typically know what we're doing at any given time. We're usually flying by the seat of our pants and figuring things out as we go. When you have access to capital, you have the ability to make more mistakes and therefore make it through those times and still actually get to the other side of that and have success. So again, the great thing is that capital really solves the number one and number two biggest problems of why we see businesses not succeed. So tapping your own savings can only go so far. Matter of fact, a lot of times, 75% of business owners are getting money from friends and family. Most of them are using their own funds, even including credit cards, which creates more problems than it solves. And a lot of them are tapping into their liquid assets as well. And again, as we mentioned, maxing out your personal credit cards tanks your personal credit scores. This is the number one biggest mistake I see business owners make. And I see business owners make a lot of mistakes, hand-raised, myself included in that mix. And the number one mistake I've seen is that business owners get in, it takes longer than we all anticipate to get the result that we anticipate on getting, and it costs more money than we anticipate it will cost. Those two things, I can tell you, in many years running a business, are the two truths that remain constant. Everything is more money than you think it's going to be and takes longer to get the result you intend on. So a lot of people think that it's only going to cost them a certain amount of money to build the business, grow the business, start the business. They start using personal credit cards to fund that. Then they realize that it takes a lot more money than anticipated, a lot longer to get the money in the door than they thought. And then they continue to add more and more and more money to these credit cards. And then it ruins their ability to get some kind of financing we're going to talk about today, as well as it tanks their credit score and makes it harder for them to even get money on the personal side they may need. So what do you do instead? Well, again, business funding comes in a lot of different flavors. And this is really what it comes down to, is being creative and going in and tapping into the financing that's actually out there. So first, there's credit, right? This is when you're leveraging credit. Now, typically for a lot of business funding, you're leveraging personal credit, meaning that some of this credit is driven based on your personal credit quality, while as more funding opens up for you as well when you build your business credit. Collateral is the second one. What do you have that's an asset of value? If you have assets of value that the lender can simply take back if you default on the loan, well, then that offers the lender a lot of security, because if you do default, they at least recover part, if not all, of what they actually lent out. And the third aspect is cash flow. Are you generating revenue now? If you are generating revenue, especially if lenders can see that that revenue is increasing from month to month, and especially if they could then see that you're starting to make profits, the more of those things ring true, the more options become available. So what's nice about what you see here is the more of any of these things you have, the more funding options open up for you. If you have the credit, that opens up funding. If you have collateral, it opens up funding. If you have cash flow, it opens up funding. If you have all three, then it opens up all kinds of funding, including term loans, lines of credit, SBA. So again, the more of these credit, collateral, and cash flow criteria you have, the more money you're able to get. Now, what you need to do is demonstrate which one of these three you do have. So part of the reason that I do what I do is because there's tremendous amounts of capital available right now to small business owners. But the problem is that I, many years ago, realized I didn't know anything about the differences between all these types of capital that are out there. And this is what we see with so many small business owners. They're busy building a business. And the problem is they don't have time to learn about the hundreds of different types of lenders and funding programs there are. But the simplest way to boil it down is this. They're looking for one of these three things: cash flow, credit, or collateral. And depending on which one you have will determine the kind of funding that then becomes available for you in your business. So if you're leveraging personal credit, well, then cash flow and collateral don't matter. And that's the nice thing about this. If we look at cash flow, credit, and collateral, the three C's, if you have one, you don't need the others. So in this case, if you have the credit, you just don't need the collateral. You don't need the cash flow. So credit lines are available, for example, if you have a 680 FICO score or better. So if you have a FICO score of 680 or a guarantor that does, maybe you don't, but maybe mom, dad, grandpa, grandma, potential investor, friend does have that score, then that can be leveraged to get you access to credit lines. Now, as I mentioned, guarantors are welcome. This typically offers 0% interest rate. So great for startups. As a matter of fact, this is the #1 kind of financing that exists in the funding space for startups, in large part because you can get it only based on credit. So since you're a startup, you don't have cash flow, and it also works really well for people that have cash flow. They just don't want to prove it. They don't want to document it. There's no bank statements needed here. There's no tax returns required. And it's really beneficial because at 0% rates, especially in the startup phase, you're able to come in and get the lowest rate financing you can get while you're building the revenue of the business. Now, obviously, that helps more than just startups. It helps in any phase of funding along the way, but low rates, low payments are really, really important when it comes time to accessing capital. Plus, again, you're building business credit. So with these kind of credit lines that are out there, the nice thing is you're getting credit lines that report to the business credit reporting agencies. So you're building business credit, which opens up even more capital options for you. The other nice thing about this as well is the fact that you're actually getting this credit is reporting to the business reporting agency, not the consumer. So unlike normal credit cards that hurt your scores when you use them, this credit helps you build business credit. There's no adverse impact on your consumer credit because none of these credit lines actually report there. So this is one of the best ways I've ever seen for startups to get business funding. And again, if any of this makes sense, if you want to talk to us along the way, I give you our phone number in the beginning and end. And at the bottom, go to creditsuite.com/get funding. Super simple link that through a matter of, like 7, 8 questions or less, you're able to find all the funding you can get approved for, including this kind of funding. So cash flow and consumer credit won't matter if you're using collateral for asset or collateral-based lending. And this is referred to as either one. You'll hear it sometimes referred to as asset-based lending. You'll also see this oftentimes referred to as collateral-based lending. If you have the assets in collateral and you're going with this kind of funding, you don't have cash flow, you don't need consumer credit. So it works good no matter how bad your personal credit scores may be. Can work for you even if you're a startup or even if you just don't want to verify your income through bank statements, tax returns. You can get very low interest rates. As a matter of fact, interest rates on this kind of funding are significantly better than what you'll find with SBA. This could be 3 to 5% lower interest than you'll even find with SBA. This is some of the lowest type financing you're going to find out there. Examples, for example, or if you use your 401k or stocks or bonds to qualify, or somebody else has a 401k, stocks or bonds where you're using that kind of collateral to qualify. And you can also make use of commercial real estate financing as well. So again, we find a lot of people are trying to get a loan when there's loans for the specific purpose they seek. And for example, some of the commercial real estate funding that we do, it's actually able where the borrower is able to get in, no money down, and actually just buy the property that they're renting, and their payments stay about the same. It's one of the biggest shifts that we've started to see, whereas people that are renting buildings are able to buy the building and own the asset, keep their payments nearly the same, and do it with no money out of pocket. So that's a perfect example where a lot of people are trying to get separate kind of funding to buy buildings or for down payments. When you go with a specific type of financing for the purpose that you seek, such as commercial real estate financing, then you're able to actually get financing specifically for that purpose and do so at pretty good rates. And again, in this example, without actually needing money down. So you also may want to consider account receivables. This is the number one kind of asset used by SBA as collateral. And I tell you that because we're very big on graduating our clients from one stage of funding to another. We classify this as 3 different funding stages, and we map this out on something called a finance blueprint. The first stage is getting all the money you can get now through a lot of the options we're talking about. The second one is once you have good credit and cash flow, then you get into term loans and lines of credit. And the third, the final stage we graduate clients to is SBA loans. And what you need with SBA loans that you don't need with a lot of the other kind of funding is you need the good credit, the cash flow, and the collateral. Well, the most common kind of collateral is account receivables. So one of the steps we take to help clients qualify for SBA loans is we help them understand the importance of letting your customers pay you on terms, letting them pay you over time. Because even though it takes you a little bit longer to get paid, instead of making them pay all up front, it makes it more convenient for your customer. You attract more customers because it's more convenient and cheaper and more affordable for them to make payments versus the entire thing in one payment. You can get that money advanced to you within 24 hours, 90% of it. So if you're charging somebody $10,000 for something, well, then 9 of that 10,000 could get advanced to you the next day with this kind of financing. And it's super cheap and low rates. And the nice thing about that is it allows you to accept payments from your customers, make it easier for them to get financing. You're able to get paid that most of that money fairly quickly. And then you're building an asset that opens up collateral-based financing as well. Purchase order financing, where you're actually getting money to fulfill purchase orders. You could even use equipment financing, sale leaseback. You could borrow against equipment you already have. You could get financing to buy equipment. You could borrow against inventory you already have. You could then get financing for the purpose of getting inventory. If you're an insurance agent, book of business financing is extremely popular. There's no reason you should ever be an insurance agent and ever worry about getting money to grow, expand, or even to buy another industry or buy another practice. Because again, insurance agents can get more money than I've ever seen them need through book of business financing. There's even house reseller financing for the purpose of flipping homes. You could even get commercial vehicle financing to actually purchase vehicles as well. So to dive into these a little bit more, 401k financing is pretty simple. You're just using your 401k or that of somebody else as collateral to get financing. You could basically borrow as much as 100% of what's in your 401k that's rollable, which means that's not currently with your employer, close in a few weeks or less, and get a credit line or a loan with a rate of only 5%. So a great option to consider. Now, securities-based financing is very similar. And again, with 401k, with securities, these are collateral. This is asset-based lending. So cash flow and credit just do not matter here. Securities financing is exactly the same thing. You're just using stocks and bonds versus 401k and IRA. You still earn the interest on the stocks and bonds. Nothing really changes beyond the fact that you're basically using the stocks and bonds as leverage to be able to get funding. This is really one of my favorite kind of funding that's out there, because the reason is there's really no interference with you or the guarantor that you're using. Meaning that if you have stocks and bonds and you pledge them as collateral, they still stay invested. You still earn the interest. You still get the return. The only difference is that you're used it as leverage. And if you ever default on the loan, they take the stocks and bonds. But if you're not going to default on the loan, well, then really your stocks and bonds, you still get all the benefits of keeping those in play and get the money advanced against those. So it's an absolute fantastic way to get financing if you or someone you know owns stocks or bonds. Okay, so cash flow. Now, personal credit collateral don't matter when we look at cash flow. Okay, so this is where you can make use of something called revenue lending. Now, this is where you can start working with Square and PayPal. That's my best advice. So anybody that's starting a business or is in the stage of less than a year, some of my best advice is to get started with PayPal and Square. Now, we don't offer these kind of loans because there's no arrangement where we can, but we still promote them. I promote them aggressively for many reasons. Square and PayPal, typical revenue lending will pay you about 12% of whatever your annual revenue is. So if your annual revenue is $200,000, then a typical revenue financing program with many of the lenders that's out there, the typical revenue lending will pay you 12% of that, which is 24 grand. PayPal and Square will pay you 30% of your revenue you're running through them. So in that same scenario where you've got $200,000, they would give you $60,000 in funding versus almost all other revenue lenders that would only give you 24. That's a lot more money. And they usually don't do credit checks, especially on smaller amounts. The fees are make sense and much cheaper than a lot of revenue lending options. So I think PayPal and Square are a great way to go. I think every business should be running part of their payments through PayPal or Square because it opens up funding for you a few months into business, 3 months into business. You start getting the ability to actually access capital. And because they have so much history of your payments and know when your deposits are, their algorithms are so good that they're able to just lend more money at better terms than most other sources that are out there because the other sources don't have that information. And this is why PayPal in their latest letter to investors basically claims that they believe that they are one of the top 5 business lenders in the business lending space based on volume. So if you don't think as PayPal is a lender, well, you should probably start to. Because like I said, if they're looking at all the analytics and saying that they're one of the top 5 of volume business lenders in the space, guys, that's something you want to pay attention to. So start running credit cards, part of them through PayPal and Square. The nice thing about this is your deposits go in your bank account. So it opens up other revenue lending options for you as well. And this is just some of the easiest financing you're going to get a few months in business without a credit check. So it's something you definitely want to look into. Now, you also want to try artificial intelligence like Fundbox. Now, you can go to creditsuite.com/Fundbox to be able to get the best terms there. We do a lot of business with Fundbox, so our clients get some preferential treatment as a result of what we do. So that's creditsuite.com/Fundbox. Now, what we do, we get a Fundbox credit line. We take every single client, every client that we get a funding for, everyone, and we run them through Fundbox 100% of the time. And the reason for that is that Fundbox will typically approve you for a smaller credit line with no credit check. If you're willing to supply a credit check, if you're willing to supply tax returns, then they'll bump that up tremendously. We have a $100,000 credit line with Fundbox. No credit check was even required to get it. Think about that. That's insane. But that's because I'm not saying you're going to get it as a startup. You won't. Okay. You'll probably get $5,000 or less in the very beginning stages, but it's still a low interest rate credit line, rates under 5%. If you borrow the money, pay it back in a week, you only pay 0.5% interest. So you only pay the interest based on how long you keep the money outstanding. And at 6 months, you're only paying 4.875% rate, less than 5% if you kept the money outstanding 6 months. So again, we see a lot of our clients go into this. We run everybody into Fundbox because it uses artificial intelligence to look at your bank account. You don't need to supply bank statements. There's no credit check in the beginning. But again, if you want to get higher amounts, you supply the credit check or tax returns. A friend of mine got approved for $6,000. And he wanted the expensive revenue lending loan. We got him $6,000. We got its tax returns, and then he got bumped up to $30,000. We were very similar. We were like $5,000-$6,000 in the initial approval. Supplied tax returns, they bumped us to $30,000. We performed as agreed, and then like 6 months later, we asked them for a bump, and they bumped us all the way to $100,000. And again, we use that credit line as sparingly, but the nice thing about a credit line like that is that whenever you want to make purchases, you can make purchases. You never miss opportunities. We never miss opportunities because if we don't want to dip into cash flow to take the advantage of the opportunity, then we rely on this credit line. So I love artificial intelligence. It's eliminating a lot of the paperwork involved with business funding and expediting funding, making it faster. And Fundbox is probably one of the best out there. Another is Bluevine. We haven't had the same success with Bluevine. We've just had a lot harder time getting people approved with Bluevine as we have with Fundbox, but Bluevine is another one using artificial intelligence to offer credit lines up to 150 grand. So again, bank statements or tax returns may get you more money in those cases, as we mentioned. So have more of one of those than just cash flow credit or collateral. Well, that opens up term loans and lines of credit. So again, as I mentioned, if you have cash flow credit or collateral, it opens up a lot of these options that we just talked about. I didn't talk a lot about revenue lending beyond PayPal and Square, but there's thousands of revenue lending lenders out there that will look at your bank statements and that will lend you money based on your actual deposits. And we've done a lot of additional training on that. Now, if you have good credit and you have consistent revenue and at least 1 year's worth of tax returns, that opens up a lot of lines and credit lines and loans. So I hear this from startups a lot. They say, I want a credit line. Well, we talked about unsecured business financing. That's a great option to get that money. But the real credit lines, the 250,000 single lines, a lot of those become available with good credit and with cash flow verifiable per tax returns, per 1 year tax returns. So consumer credit and cash flow per tax returns are needed. With these two, lines of credit and term loans are available. And with all three, that opens up the SBA loans, cash flow credit and collateral. But let's talk a little bit more about term loans. So you're coming to the end of the year, and I'm going to give you one of the best pieces of advice you're ever going to get. And you should pay very close attention to this because you only have 2 weeks to make it happen. The difference between a business that shows no profit or a loss at the end of the year versus one that shows some kind of profit is right here. Term loans and line of credit. It's very tough to get SBA loans, term loans, and line of credit. Any of those are tough to get if you don't show any profit. If you show even some profit on the tax returns, which even a minor profit will cost you minor money in taxes, especially with this new tax law, then it's worth it for you because it opens up lines of credit, term loans, and SBA loans. If you file your tax returns as you're going to by March, hopefully, and you don't show a profit, then you need to know that you just lost another year of having the ability to really access most of the lines of credit and term loans that are out there. So most people want low interest rate, long-term financing. Low rates, long terms make for loan payments, okay? The problem is, and I'll give you an idea of that. Okay, if you do an SBA loan at 8% for 10 years, which is normal, you could get about $325,000, $325,000, with a payment of about $3,500 a month. To give you an idea, $3,500 a month for about $325,000 of financing. To give you a comparison, if you went into revenue lending and did that over 3 years with their standard rates, you'd probably get about $60,000 and you would spend about $9,000 a month to get it. Triple the payment to get a fraction, like a fifth of the financing. So my goal for you is to get you here. We need to get you to lines of credit. We need to get you to term loans. We need to get you to SBA loans. That's when you can get a lot of money, and the term is so good, and the term is so long, and the rate is so small that's when you get a lot of money with really affordable payments. You need to understand the key to this is to have tax returns that show some kind of profit. If you don't have that, you have to wait till the following year until you do have it to get it. It becomes very, very important in this business financing space. And again, as we talked about with SBA, they're going to want good credit, cash flow, and collateral as well. What if you have none of these? Well, then you still have some choices here. Okay, you could sell part of the business, which is called equity financing, right? So we're used to this on Shark Tank. Almost everybody here has seen Shark Tank. Shark Tank is where you give a piece of equity ownership in the business up for actual capital. The problem with it is, as you can see on Shark Tank, is these guys don't want 5%. They want 45, 50, 60% of the business in a lot of cases. So venture capitalists want more than angel investors do, but you have to decide. You're going to give up part of the equity to get that cash that you actually need, or you can get crowdfunding. Crowdfunding is another great way to go, but that's only going to work if you have a really unique idea. You can't be a real estate investor and try to go get money through crowdfunding. It's just not going to work. But if you invented something that's like super cool and rare that people haven't seen before, then that's when crowdfunding can really work for you. And the other option here is grants, free money. Get money from the state, get money from the county, get money for your industry in the town that you're in. You can also build business credit. as well. Business credit allows you to get 10, 20, 30, 40, $50,000 Amex credit cards, Visa credit cards, Apple, Dell credit cards without credit checks, without guarantees, without cash flow. This is why we talk about business credit so much. It's a catch-all. Everybody can get it. You don't need the cash flow. You don't need the credit. You don't need the collateral. And even if you can get other business funding, your business credit scores will often determine the rate you'll pay. The amount of recommended credit from the bureaus determines how much you'll get, and the quality of your business credit oftentimes determines if you'll get approved or denied. So you need to build business credit either way, but it's a great way to get money even if you can't get any of this. So remember, you can sell part of the business for equity financing, and that also means you're going to give up some form of control. Now, angel investors, the ones you get money from in the startup phase, the first 2 stages of business funding come from angels, and those angel investors don't usually want big commanding ownership control of your business. They typically want a smaller ownership interest, and they don't even usually care if they sit on your board of directors. They don't even care if you maybe have a board of directors or not, because it's smaller amounts of money. But venture capitalists do. Venture capital is going to want a larger ownership stake. They're going to want to sit on the board, meaning they're going to want to command your actual decisions. And look, a lot of these guys are notorious for wanting to push you out as the owner when the business is doing well, and then push themselves in, or somebody with more experience. So these are things to keep in mind, angel investing and venture capitalists. Now, angels, again, are informal investors. They usually invest in the start of a company, and this is often in swap for equity, which is essentially the collateral. They can even invest via a crowdfunding platform. Nowadays, angel investors and angel investing platforms are coming up that allow angel investors to pool their money into these networks and lend more money. Now, I love this new shift. This new shift in business lending for you and I is a really big deal, because what we've done is they've gone to average people and said, hey, average person, do you want to invest money into this? And you can invest in businesses. It's another way to invest versus real estate or putting money in the stock market for publicly traded companies. You can now invest into smaller businesses. And these angel investing networks allow you to put $100 in, $5,000 in, $1,000 in. Then they take your money, they pool it with other angel investors. Then they come up with $10,000, $15,000, $20,000 to actually loan out. So you still get a rate of return if the loan succeeds as the investor. And it's a great way to pool money, which makes it more available than ever for angel or for small businesses that are getting angel investing. Venture capitalists, they want more money. They're typically not with the startup side of things. They're usually on the 3rd stage of funding. They're usually getting involved when you're producing revenue, not necessarily profits, but when you're producing revenue and selling stuff, that's when these guys usually are getting involved. And they're very interesting because them and angels want high-risk businesses. That's why you want to pay attention to venture capitalists and angel investors, because most lenders are very concerned with risk and they want small risk. These guys welcome big risk. They want huge risk, because huge risk means huge returns. And they know they're going to strike out 8 out of 10 times. And one time they may succeed, and another, they're hoping for a home run. So that's what these guys are hoping for, but they're not going to hit home runs with low risk. They want high risk. Okay, so they're looking for fast growth companies with an exit strategy in place. They want something that can grow really fast and in 3 years can be sold. So if you don't have a concept where the company can grow really fast and be sold in 3 years, well, these probably are not going to be the best sources for you. Now, venture capitalists are often going to want to recover their investment, as I mentioned, in 3 to 5 years, and they're also going to want that larger piece of ownership in your business. So let's talk about grants and crowdfunding. Well, they both have limitations. They can work well for some industries. Don't make them the cornerstone of your funding strategy, but they can fill in the actual gap. So when we talk about grants, some of the most popular ones come from HUD, Housing and Urban Development. Okay, you can also, if a business isn't related to housing or city development, it's not going to be approved. But if so, then you can go to portal.hud.gov and search HUD grants. Notice of funding availability include the contact where to send the actual application. And if applying for more than one HUD grant has been separate, you have to submit a separate application. Now, you could do USDA for rural areas, okay? And they're not just grants and ranchers. They give money to waste management and energy company and housing preservationists as well. A state or local government might provide grants. And we see a lot of this right now where they were trying to woo Amazon for their headquarters. And then Amazon did a bait and switch and said, we really are going to have 2 headquarters. And they're really regional offices, not big ones. But the whole purpose of that whole ruse was just to get states to concede and give up taxes. Okay, so the whole idea here is that states want you to have businesses because that employs people. And when they employ people, then that means more people live in the communities, right? And then that attracts more people to the state, the community, and that brings in more tax dollars. So the whole idea is to attract business because when business comes in, then people move their residences. And when people have residences, then they pay taxes in the state, the county, the city earns that money. So check, because a lot of your local cities, your provinces, your states, your counties, a lot of those have grants. And again, the nice thing about this grants is it's free money. It doesn't have to actually be repaid. So you want to look into any of those, even including the local projects as well. Now, crowdfunding comes from platforms like Kickstarter or Indiegogo, gathers money from a lot of people instead of one investor. And if the crowd likes the idea, well, then they decide to donate to the project. But a good pitch is really vital to the success here. Now, generally, crowdfunding won't need to be paid back, but read all the fine print. Many crowdfunding platforms will give all the cash back to the investors if you do not meet the goal. So you want to look for what's called flexible funding. And Indiegogo is notorious for this, where they allow you to keep the money even if you don't hit your goal. So this means like if you're trying to raise 10 grand, you only raise 8 grand. Kickstarter would give all that 8 grand back because you didn't meet your goal of 10 grand. But Indiegogo would let you keep the 8 grand. So big differences between that when it comes to crowdfunding. And they take about 5% of the money you get as donations. My 2 biggest tips of crowdfunding are always the same. Number 1, raise potential or get potential investors committed before you ever actually go in and start to try to raise money. Meaning that these platforms need to see social proof. They need to see that a lot of people are looking at the paid crowdfunding page you created. And then a lot of people are donating before they start to show it to more people. It's kind of like Facebook, right? So like if you post something on Facebook, your Facebook's not going to show that post to all your friends or over and over unless people engage with it. But if you've ever had a post on Facebook that like really everybody's clicking and liking and commenting on, well, then that continues to get more and more engagement because Facebook shows it more and more times to more and more people. Same thing here. The more and more activity that crowdfunding platforms see that campaign has, the more people they show it to. That's what creates the virality. So your ability to share this amongst your social network and raise investors before the crowdfunding project goes viral or goes public actually becomes really important. Now, you building business credit. So this is where you start with vendor credit, like Uline and Quill, for example. Then you move on to revolving store credit, like Amazon, Walmart, and Apple, for example. Then you move on to fleet credit. These are gas cards. These are fuel cards. These are WEX fleet accounts and RGS fleet cards. These are really for people that are looking for fuel and maintenance repairs, people in transportation, for example. Then you move on to the Visa card, the MasterCard, the American Express. Now, the nice thing about building business credit is that, our clients, for example, can get all the way to the end in about 6 months' time. It takes obviously longer if you're trying to figure out the process on your own. Could take you about 2 years. But again, if you know what you're doing and you're coming in here succeeding, you can get all the way to $20,000, $30,000 Visa card, MasterCard in 6 months' time, all without a personal credit check and guarantee. So really good process to go through. You just want to make sure that you're paying all the bills on time. For anything that reports on your business credit reports, including business credit cards, because your payments are primarily driven or your scores are primarily driven based on how you pay. And you want to be patient. You got to follow the steps in order for building business credit. Okay. We've got a lot of training at youtube.com/credit suite on the steps to do this, but you need to follow those steps in order. Don't try to go get the Visa card first. You're never going to succeed. The reason most businesses and small businesses don't have this, they don't know the proper steps to get it. So follow our training, follow the right steps, and that'll help you secure another way of getting money as well. Now, alternative lenders are offering lines of credit 50 to 100 grand. They usually want to see at least a year's worth of tax returns. Okay, if you want over 100 grand, they may ask for things like P&Ls and bank balance sheets. Okay, and again, these take a little bit longer to close, about 30 to 60 days for SBA and these kind of loans, but the rates are about equivalent to SBA, about 7 to 10%. And again, the approval is usually 10% of annual sales per your tax returns. You'll need an experience score of about 700. So again, when we talk about these lines lines of credit, this is when we're really looking at somebody that has better credit than at least 1 year of tax returns. SBA is going to want 2 to 3 years of tax returns to get approved. So be creative when seeking funding, all right? Leverage personal credit, collateral cash flow. You need to know that the primary goal of any lender is they worry about the fact that you're going to be able to pay them back. That's their only concern is, are you going to pay them back? So don't try to go in and be naive and think somebody's just going to give you money just because you want money and thinking about starting a business. You have to have a lendable strength to get money, period. If you have a lendable strength, then it's fairly easy to get money based on that lendable strength. If you don't have a lendable strength, you need to know that cash flow, credit, and collateral is what these guys are looking for. So then that way you can start getting one of these three things to become lendable, or focus on the other options we talked about, the grants, the crowdfunding, the business credit, the angel investors, that you can get money from even if you don't have one of these already. Okay, try selling part of the business. Remember, VCs, angels can work for you as well. Angels are who you're going to get started with. Also, remember with angel investing, there's two kinds of angels. There's ones that you actually know, and there's ones you don't. Okay, and the ones that you don't know is what you typically think about angel investing. But what most people don't know is most angel investing comes from people that you actually already know. It comes from people in your circle. And if you have those kind of what are called affiliated angels, it makes it easier to attract unaffiliated angels. When you can go to pitch unaffiliated angels that don't know you and say, look, I already got 3 angels on board and it's grandpa, friend, and somebody else. Well, that makes them feel better, because the people that know you are willing to invest in you in the business, then it gives them a little bit of peace of mind. Securing grants, crowdfunding, other great ways to go, because this money typically doesn't need to be paid back. So you don't have payments on it like you do loans. And don't forget, building business credit helps you get access to money. And it also gives you a funding solution, even if you can't come in and get any of the other funding solutions that we talked about as well. So, again, if you have any questions on getting financing, this is not a purpose of bringing in all the specific kind of financing, right? We didn't really talk in depth about a lot of different kind of financing. It's available out there, merchant cash advances and other kind of revenue lending. We didn't talk in depth about the commercial vehicle financing or house resale or book of business financing. We got a lot of that on our YouTube channel. So visit us on YouTube. If you like this content, well, then like and subscribe. Okay, that way you get notified when we go live every week. That makes a lot of sense. And if you're listening on iTunes, then go ahead and give us a review if you like what you're hearing as well. Feel free to get in touch with us. If you're interested in getting money for your business, you need to know that we never charge you a dime of money to get money for your business. It doesn't cost you anything from us. The lenders will still charge rates and fees, and we negotiate to get those better for you because we do so much volume with the lenders, but it never costs you a dime of money for us to help you get funding at all. As a matter of fact, we typically get you more money at better terms without charging you any kind of fee, no application fee, no points rolled in the back end. So it's free for us to help. So feel free to give us a ring, 877-600-2487, info@creditsuite.com. You can go to creditsuite.com/get funding. And also don't forget to check us out at the top right of our page, creditsuite.com. You can follow us on iTunes, listen on the go. Audio is becoming the new media that everybody likes to hear, because of that medium, you can listen on the go. You can also check us out on YouTube, where we go live every Tuesday at 1. We go live on Facebook Wednesday at 4. And the nice thing about that, you can interact with me. You can ask questions. I can answer your questions in real time. And I'm not, not off camera. I'm on camera right there using whiteboards and chalkboards to teach you a bunch of cool principles. So make sure you check us out online. We even have Instagram, Twitter, where we're releasing daily tips as well. So again, make sure you follow us on social. We'll notify you when we go live and give you a bunch of other information about helping you become more fundable, about building your business credit and accessing all different kind of loans and credit lines as well. Thanks everybody for tuning in. I hope you all have a great day. Thanks everybody.